company which is trying to enter into the securities exchange. All right. Yes. So we're looking at part B of this question. All right. We're asking us, using the dividend discount model and the price to earnings ratio method, calculate the intrinsic value of ZEC's shares. Based on these calculations and the offer price of 5 kwacha, is the share undervalued or overvalued? Show all your workings. Okay. So ZEC goes with the offer price to Pangaea Securities and says the offer price is 5 kwacha. So remember, one of the roles of an investment bank is to help you determine the price of your share. They help you determine what you call is the intrinsic value of your shares. Okay, intrinsic value basically just like this is the fair value. This is what you sell your shares for. Okay. Then you compare them with the offer prices to see if the shares have been undervalued or overvalued. Okay. And then you'll be able to determine which share price to choose. So first of all, we need to go through this financial data. We need to understand all these terms. The first term here is what you call earnings per share. Okay? Earnings per share. Colleagues, what is earnings per share? Anybody to give us the definition of earnings per share? Because this is the language you need to start understanding for this course. Okay? These words. Yes, anybody?
Is how much you'll be earning the each year?
Yes. Okay. From the company, if the company's profits shared amongst all the shareholders, is how much you earn for holding each share. Are we okay with that, colleagues? How much you're earning for holding a share? Okay. The assumption is the company on the financial statement you see there net profit. That net profit, if it's distributed amongst all shareholders, that's the earnings per share. Okay. So for ZEC, the earnings per share is 45 ngwe. Okay. That's how much you're earning for. That's how much you can potentially earn, because in reality, colleagues, the company is not going to give the whole net profit to the shareholders. Okay. Unless they love the shareholders that much. Okay. You give all the net profit to them. So this is what you could potentially earn as a shareholder at ZEC. Okay. So as an investor, a higher earnings per share, it's a better indicator for a company. Okay. Yes. Dividend per share. Yes, colleagues, as the name suggests, the dividend per share is the dividend you're going to be getting for each share. Okay. The dividend you get for each share. Let me just get some bundles. Sorry about that. Just kick it out. Yes, so dividend per share is just what do you call this? The dividend you're earning for each share. Okay. When the company declares an amount of dividends that will be paid out, and it's paid out, you divide it by the number of shares, and then you see the dividend each shareholder is getting. Okay, so here the dividend per share is 20 ngwe. The historical dividend growth rate, okay, 5%. So it means the dividend growth rate is going to be, the dividends will be growing at 5%. Okay, forever basically. That's why you say constant growth here. Okay, the dividend discount model. There are three types. There's no growth. Okay, then you've got constant growth, and then you've got multiple stage growth, where the dividend, the growth rate starts changing. Okay, so here what we're assuming is that the dividends are going to grow at 5% per year. Okay, that's just the assumption. Companies beta, okay, equity beta. This is it measures the risk of the company. Okay, the risk of the company in relation to the stock market. Okay. What risk are we talking about? We are talking about systematic risk. Okay, very important in this course, investment management and portfolio analysis. The difference between systematic and unsystematic risk. Colleagues, what's the difference between systematic and unsystematic risk? I know someone knows. Somebody somewhere knows. Systematic risk, please remember this and never forget this. Systematic risk is the risk that affects the whole stock market. Okay, you cannot avoid it. Okay, the whole stock market. You cannot diversify away this risk with a portfolio. Okay, remember a portfolio is just a group of investments. Okay, so with the portfolio, you are trying to minimize unsystematic risk. Okay, unsystematic risk is just a risk specific to a certain industry. Okay, unsystematic. Okay, unsystematic risk is industry specific, and this can be it can be diversified away by a portfolio, just by different shares in different industries, and you get rid of this risk. Okay, so systematic is the whole market. You cannot run away from it. Okay? It affects the whole economy. Like let's say this war in Iran, all right? It's going to affect fuel prices. Okay, those fuel prices are also going to have some form of effect on a lot of companies that rely on fuel. Okay? Because if you are a company on the, let's say, the New York stock market, and now you're having shortages of fuel in your company, it means you'll be making. It means whatever you are making, you make less, and you start making losses. And when you start making losses, what's going to happen to your share price? Your share price is going to drop. Okay. So someone who has invested in that company, okay, is going to suffer that risk. But if you make a portfolio where you have invested in different sectors, okay, you find industries that are affected by the oil market won't affect you. Yes. So beta measures systematic risk, okay, the risk which is in line with the whole market, where the whole market is affected. Alright. And remember, in the investing game, okay, the higher the risk, the higher the returns. Okay. For someone to invest in ZEC, a new company that's coming on the securities exchange, okay, it's a risk for them. Okay, because let's say this company buys this new plant, okay, in southern province, starts working, and then it starts making losses. It means if it makes losses, you won't earn any dividend, okay, because it's a new company coming in. Okay, so you'll be a bit skeptic. Okay, so to compensate you for the risks that you take when you invest in ZEC, you have to get a high return for the high risk. Okay, colleagues? And that's what the capital asset pricing model tells us. Higher risk, higher return. Okay? Higher beta, higher returns. Lower beta, lower returns. So let me just also illustrate to you how you can visualize this beta, because this beta is in relation to the stock market. Okay? So if you have a beta of 1.3, it means whatever happens to the stock market is going to happen worse to your company. Okay? So this line in black is the Osaka Securities Exchange. Okay. If the stock market is doing well, okay, it grows, maybe let's say by 9%, it's growing. So for a company like ZEC with a higher beta, the growth will be higher than the market. Maybe let's say here it's 9, maybe the growth might be 12%. Okay, which is a good thing, because you earn more returns than the average companies in the stock market. Okay, that's the good side of having a high beta. The stock market, the stock market grows, you're going to grow at a higher rate. But if the stock market drops, let's say from 9%, then it drops by 20%. Then for ZEC, it's going to drop way greater than 20%. It might drop by 40%. Okay? Might drop 40%. And here, you'll be affected worse than the other industries. Okay? So beta is also put in relation to the stock market. Okay? The stock market has a beta of 1. Okay? So if your beta is higher than the stock market, whatever happens to the stock market, it will happen more to your company. If your beta is less than 1, whatever happens to the stock market, it will happen less to your company. Any questions? Risk-free rate. This is the interest you're going to earn on government securities. Okay, government, theoretically, they cannot default payments because they can print money through the central bank. Okay, so you eventually get paid. They are not running anywhere. The company can run away. Okay, it might close. Okay, that's why company bonds are more, have to offer higher returns than government bonds, because company bonds, there's that risk the company doesn't make a profit. Okay? It makes a loss, it closes down, so you find you don't get paid. Okay? So the risk rate is 12%. Alright. So as I said, in the stock market, Risk-free investments give the lowest returns. Okay? They give the lowest returns. Risk-free investments give the lower returns. Okay? Because for you to get a higher return, you have to get a higher risk. So if you go for something that's low risk, expect low returns. As I said, this is like gambling. Okay, with gambling, you put in more money, bigger losses, bigger risk. Okay, but there's also a bigger chance of earning a bigger profit. If you put in less money, you lose less money, lower risk, but your profits are going to be small. That's the whole same concept here. Expected market return is 18%. This is just the average return that you're going to get if you invest in any company within the Lusaka Securities Exchange. On average, expect a return of 18%. Okay, that's what the expected market return is. On average, if you invest in any shares in any company, on average, you get 18%. Okay. Then you got the industry average price to earnings ratio. The price to earnings ratio is comparing how much you pay for a share. This is how much you're going to earn for that share. Okay? Comparing how much you pay or how much you're going to earn. Okay? So a price to earnings ratio of 11.5 kwacha means you're willing to pay 11.5 kwacha for a single share. We need to pay 11.5 kwacha in order to earn the 1 kwacha. That's what this means. We're willing to pay 11.5 to earn a 1 kwacha. So this is what this financial data is. So let's go to part B of the question so that we see if ZTC shares are over or undervalued. So we're going to use the dividend discount model, the constant growth model. This is the formula for the dividend discount model. The price of the share, this is the intrinsic value, how much the share should be sold for, is next year's dividend, D1. Okay, D1 is next year's dividend over the expected rate of return, RE, or sometimes you see it as cost of equity. You might see a KE, minus the growth rate. Okay, this is under the dividend discount model. D1, next year's expected dividend over the expected return minus the growth rate. So from this information here, okay, we already have the growth rate. The growth rate, G, so that is 5%. Growth rate is 5%. D1, next year's dividend. D1 equals current dividend, DO, multiplied by 1 plus the growth rate. Okay. So the current dividend you go and get from dividend per share, 0.2. Okay. Since you're saying the dividend is going to grow at 5%, so if this year you're getting a dividend of 20 ngwe, next year you expect a dividend of, we're going to say 1 plus the growth rate is 0.5, 0.05, 5% is 0.05 in decimal. So I'm going to say 0.2 multiplied by 1.05. Colleagues, those are calculators, 0.2 multiplied by 1.05. Oh, I already calculated it 2 times 1.05, 0.21. So next year, you're expecting a dividend of 21 kwacha. Okay. So we've got D1, we've got the growth rate, but we do not have the expected rate of return. Okay. Or sometimes also called the cost of equity. Some books you see it written like this: KE, cost of equity from the company's perspective. RE, required rate of return from the investor's perspective. Okay. Yes. So if you see KE or RE, same thing. Okay. So we need to tabulate this cost of equity or the expected return. Okay. So this is where we're going to use the capital asset pricing model. Okay. Capital asset pricing model, this is the formula: KE equals the risk-free rate plus equity beta, open brackets, the return on the market minus the risk-free rate. Okay. So we defined these terms earlier on. Okay. The risk-free rate is 12%. Okay. Now sometimes in questions, colleagues, they might not tell you that that's the risk-free rate. They'll just say the interest on treasury bills is this percent. So if you just see treasury bills, treasury bonds, there's an interest rate attached to them, that is the risk-free rate. It's not always going to be blatantly given to you. So remember, if you see a government security and you see a percentage attached, that's the risk-free rate. Equity beta 1.3. Okay. This section here, return on market minus the risk-free rate, is called the equity premium or the market risk premium. What it is just telling you is this: if you choose to invest in securities that have risks, you're going to get an extra return over someone who invests in a risk-free investment. Okay? It's the extra return you're getting for investment in a riskier securities. Okay? Equity premium or market risk premium is the extra return you are getting, okay, for investing in these riskier securities. Okay? As we said earlier on, the more return you want, the more risk you have to incur. So if you invest in other securities apart from government securities, you have to get an extra return over someone who has invested in the government security. I hope that is clear. Are there any questions on that? Expected market return 18%.
Hello?
Hello?
Just on the formula, the KE equals, I don't know, so there's the capital R, then that is the F.
Yes.
After capital R, then B.
RF, then beta,
Okay.
then RM, return on market. Expect this one, expected market return is the RM.
Okay. Then this is minus R, what, that's F again.
Yes, RF. So when we do our tabulations, colleagues, okay, if you want, you can leave it as percentages. If you want, you can convert them into decimals. To make life easy, just leave them as percentages, okay? Yes. So if you invest in securities in the stock market, the average return is 18%. If you invest in a risk-free security, you're getting 12%. So the extra return that you are getting when you choose to invest in the stock market, not in the, you choose to invest in other securities in the stock market instead of a risk-free investment, is 6%. Okay? getting a 6% extra return for taking the risk. Okay, you are getting a 6% extra return for taking the risk. That is what equity premium is. The extra return you get for undertaking risk. Okay. Then you just multiply 1.3 times 0.06, you get 0.078. Add that plus 0.12, you get 0.198, which is 19.8%. Okay. This is the expected return. This is if what this means basically is this. Okay. If someone should invest in ZEC, the minimum return they should expect is 19.8. That's what the expected return is telling you. Okay? That if you invest in this company, this is the minimum return that you should expect. Anything less is a non-starter. Okay? Yes. So once you found KE, we go back to our formula here. Okay? The intrinsic value D1, next year's dividend over KE minus G. Okay, so 0.21 over 0.18 minus 0.05. Remember, this 0.05 is the growth rate. Okay, it is the growth rate. So 0.198 minus 0.05 gives 0.418. 0.21 divided by 0.148, you get 1.42. Okay. So, according to the dividend discount model, ZEC should sell their shares at 1.42 kwacha. That's what we're saying here. According to this model, ZEC sell their shares at 1 kwacha 42. Okay. So remember the offer price. ZEC came with the offer price and said want to sell the shares at 5 kwacha. And your intrinsic value, which you've tabulated, is 1.42. Okay. So the intrinsic value is less than the offer price, so it's undervalued. Okay, this share is undervalued. If the intrinsic value, okay, PO, intrinsic value, if the intrinsic value is less than the offer price, share is undervalued. Okay. If the intrinsic price is greater than the offer price, okay, then your share is overvalued. So here, this share is under the dividend discount model, it's undervalued. Any questions before we go to the PE ratio method? Alright, PE ratio is the earnings per share multiplied by the industry average PE. Okay. So we can see these figures. The industry average price to earnings ratio is 11.5. Earnings per share of ZEC is 0.45. So I'm going to say 0.45 multiplied by 11.5. Okay, you get 5.175, which you can round off to 5.18. Okay. So according to the PE ratio method, ZDC should sell the shares at 5 kwacha 18 ngwe. So here in this case, the intrinsic value is greater than the offer price, so it's overvalued. It's greater than by 18 anyway. So here, under the P ratio method, it's overvalued. So colleagues, the question now comes here now. If you are Pangea Securities, what price would you tell ZDC to sell their share? Would you tell them to sell at their undervalued price, under the undervalued price, or at the overvalued price? Madam Josephine?
Yes,
Yes, what would you
I
tell
was
them?
trying to. No, I was trying to write what you. Now the screen has moved. I've not copied what you have written there.
Okay. It's good you're writing. Yes. Colleagues, so if you're Pangea Securities, what would you tell ZDC? Or which price would you tell them to offer?